Next, we have non-current notes payable. Sometimes we purchase machinery, plant, or sometimes we purchase merchandise, and instead of making instant payment, we can issue notes to our suppliers or to our providers of capital assets. Like in this example, there are three types of non-current notes payable. Discuss them one by one. This is the first type, where we just make a single payment, one principal payment. An entity agrees to give in return for merchandise a 3-year 100,000 notes bearing 8% interest paid annually. So I've got goods, I purchase goods. Instead of making payment now, I have issued a note payable that carries 8% interest, and I will make the full payment at the end of the term of this note. The effective interest rate is 6%. Now, the difference is I'm going to make the payment at this rate. This is the stated rate, also called the coupon rate, but the rate prevalent in the market at the date of issuance of these notes was 6%. This is called the market rate, right? Remember, interest is paid at the stated rate we have just discussed, whereas the valuation is done at the market rate. You will see that in the video I will share with you how the bonds are valued. Valuation is beyond the scope of your CMA part 1, but if you are interested, you can see that video. Now, because the note stated rate is more than the effective rate, so it will be issued at a premium. How do we calculate? This is how it's done. I told you the value of a bond or a note is the present value of the principal and the present value of interest. Please try to just focus a little for just these 3 examples. I'm going to make a payment of $100,000 at the end of the 3rd year. I will go to the present value table. Under the present value table, I will see a discount factor in the 3rd year under 6%. This factor will be, you can see this in the present value table, is going to 0.83962, which means the $100,000 which I will pay at the end of the 3rd year, if I multiply this with this factor, this will convert this $100,000 3rd year outflow into its present value, 83,962. At the same time, I will also be making interest payments in year 1, year 2, year 3 at the rate of 8% of $100,000 is going to be 8,000 in year 1, 8,000 in year 2, 8,000 in year 3. I need to bring these 3 cash flows into their present terms. I want to calculate their present value. So instead of just multiplying them with the discount factor for the 1st year at 6%, discount factor for the 2nd year at the rate of 6%, and discount factor of the 3rd year at the rate of 6%, I can simply use an annuity factor for the 3 periods at 6%, which is given as 2.6730. This annuity factor will bring present value of all the 3 cash flows. So in other words, if 8,000 is to be paid in the year 1, 2, 3, multiplying this 8,000 with 2.67301, it will bring, or it will return, the present value of these 3 payments that I will make in the future. Now, present value of principal and present value of these 3 interest payment equals 105,346. The extra 5346, this is the premium, right? Face value is this, and this is the premium. So the entry I'm going to make, I'm going to debit the inventory, credit the premium and notes payable, and credit the note payable. The amortization of this premium is exactly done in the same way that you have just seen in case of bonds issued at premium. The same amortization. This is not examinable, just for the sake of filling this topic. Second type of notes payable are the one that carry a separate part of interest and separate principal. Let's read this one. Shah Company borrowed 120,000 on a 10% notes payable to a bank. We borrowed 120,000 from a bank, and to the bank we have given them notes. We will pay in tranches, we will pay in parts. Shah Company borrowed 120 from the bank, and in return, we have given notes to the bank at 10%. Under the condition, 3 equal annual principal payments will be made, 40,000 plus interest at the beginning of December 31st, year 1. Now, we receive $120,000. For the whole year, the interest is going to be 120 times 10%, 12,000. This is the interest we will pay, plus 40,000, the principal. 40 plus 12. Total payment will be 52. Out of this, 40 is the principal. 120 less 40, the principal will fall from 120 to 80. Now, the new principal is 80. Next year interest will be calculated on this. 80,000, 10% gives you 8,000. This is the interest. And since we have to make equal payments of 40-40 every year, so the next year payment is going to be 40,000 principal, 8,000 interest, 48,000. That's the payment in the total payment in the second year. Now, this leaves us the principal to be 80 less 40, just 40. And in the third year, 40,000 is the opening balance of loan times 10%, 4,000 will be the interest, and remaining the principal 40. So you will make a total 44 payment. At the end of the third year, the total amount is paid. This is where there is periodic principal payment of equal amount, and the interest is calculated based upon the opening balance of your balance of the notes. The third type, a note that requires equal payment every year. 40, just like leasing. I'm sure all of you know, leasing involves a single payment, and when you make a payment, some part of it is interest, remaining is the principal. As you keep on making the payments, the interest element keeps on falling. Interest in the first payment is 12. Interest part in the second payment is this. How is calculated? Let me show you. Star Company borrowed 120,000 on a 10% note payable to bank. 3 equal annual installments of 48,254 are to be paid beginning 31st year 1. We receive 120,000 from the bank. Interest on this is going to be 120 times 10%, 12,000. Since as per the agreement, we have to pay 48,254 to the bank. 48,254 is the total payment, out of which 12,000 is interest. 48,254 less 12, the balance will be clearly principal. This is the principal payment made in the first year. What is the remaining principal? 120 less 36,254, 83,746. This is the new principal at the start of year 2. Interest for year 2 is going to be 83,746 times 10%, 8375. Since we have to make a constant payment of 48,254, this is the payment, out of which this is the interest. Payment less interest, remaining will be principal, 39,879. 83,746 opening principal, principal paid will give you the closing principal, 43,867. This is now the new principal at the start of year 3. Interest in year 3 is going to be 10% of this amount, 4387. If this is the interest payment, but this is the total amount, total payment less interest charge will give you the remaining principal, and finally your ending balance will be 0. So this was the last slide for your bonds and non-current liabilities.